name is Ben Reppond. Welcome to my YouTube broadcast. Today is Tuesday, June 17, 2025. Do you watch the news? Do you watch or do you read the news? I've got rid of my TVs, so I read it on a selective basis. I don't read a lot of news because I don't want to. But what I do read, I can tell that it seems that the world is falling apart. The news is crazy, inflammatory, negative, and there's a lot going on. I acknowledge that. But what is happening is this is impacting investors and the way they look at their money, the way they look at their investments, and people are scared. They're afraid. And so I wrote down just some headlines that I read or ones that I summarized to just give you a flavor for what's out there. And then I'm going to talk about the impact on people, on their portfolios, people who are sitting on the sidelines. How do they get back in the market with this kind of thing going on? When do they, or even do they, get back in the market? So the headlines, the kinds of things that are out there, of course, we know about the conflict in the Middle East going on, conflict, war, whatever, and U.S. cities seems like they're burning or being rioted out of control, many major cities. Then I read things like the housing market is crashing, the dollar is collapsing, bonds will crash this year. The stock market will crash this year or next. China will go to war with Taiwan, or at least it is imminent. And then the Russia-Ukraine war is still going, and there's headlines around that. Your bank account will become worthless. Gold is going to $27,000. I'm not making this stuff up. This is stuff that I've read. Hyperinflation is in our future. China will invade the U.S. And then last week I read Jim Rickards said, I'm terrified of the next 3 weeks. So when you read things like this or hear them on the news, you don't know what to do. And people don't want to lose their money. They don't want to lose some portion of their money. But a lot of people are invested in traditional buy and hold 60-40 stock and bond portfolios. But regardless of what you're invested in, the method that you use, it is still frightening. I think the headlines are intended to scare investors. I put on the cover slide this week a picture of soup kitchens back to the Great Depression, and things like that are used. And that kind of imagery is what does stick in people's minds. So what can you do? You could use the traditional approach. The reason I say this, let me back up a minute. People have a portion, some people have a portion of their money, maybe all of their money, sitting in money market funds or in cash, short-term treasuries, things like that. And their goal is to protect their money and then find a time to get back into the market. So what do? And when do you do it? Do you take the traditional approach, or do you maybe chase some hot stocks? Tesla, Nvidia, there's a lot of them out there, whatever the current one is. If you do, and you know that these hot stocks go crazy high, but they drop like a rock. And the way I think of it is, if you do that, you're going to get, or have gotten, your head handed to you on a platter. The core component of any strategy, investing strategy, is risk control. You must have it. You can get it a lot of different ways. The common way to do it is bonds. Put bonds together with stocks. That has not worked well at all for, say, the last 5 years, because bonds have been collapsing. Now, I'm going to show you a chart of the long-term government bond, the ETF TLT, or it could be the intermediate term bond, IEF, or it could be corporate bonds or municipal bonds, some kind of bonds that provide stability to the portfolio. But a lot of people use the government bonds, whether it's intermediate or long-term, because they are quite a bit non-correlated, or have been for the 40-year period of 1981 to 2021-ish. And so that has formed as a pretty good counterbalance for equities and risk control. But in the last 5 years, 4 or 5 years, they have been terrible, and they have been collapsing. Now, take a look at this chart, and you can see that in this period of time, the long-term government bond has dropped about 50%. How's that for risk control? Stocks need a counterbalance. Bonds are not providing it. And so if you're in a traditional portfolio, you use that, or an advisor does it on your behalf, you know what I'm talking about. The returns are either negative or anemic, period, for years. So people are frustrated. Do you want to go into that? I don't. So I talk to investors from all over the U.S. because of my channel. They call me and we have conversations, and they are afraid. And some of them have money invested, but they're afraid. And then there's, they may put it in money market or something. I understand getting out of the market, and I understand not investing in traditional methodologies. If you get out of the stock market, you have, I'll say, maybe a 50% chance of protecting some of your money for a short period of time. You may not sell at the very bottom. You may be selling, and then you protect yourself from the rest of that risk. Maybe. But the question is, the question that goes hand in hand with that is, when do you get back in, and what do you get back into? How do you do that? People don't know. And if you use that method with a traditional advisor, they don't study that. Most of them don't. So they don't know what to advise you. They just say, get into 60-40 and it'll protect it. It just doesn't. So there are two big influencing factors in the market that are pushing the market up. One is the media. The media can push it down, and the media can push it up. It's a big factor. And secondly, printed money. The Fed has, for a long, long time, 100 years, have been printing money, and that has a long-term effect to give the market an upward bias. There's institutional accounts where they do shorting and covering and things like that, but and high-frequency traders, they influence the market. But the market basically, regardless of the reason, it does have an upward bias to it. So I'm going to talk about what do I do, and what I've been doing with clients that have been moving money from money market into the market, and new clients who are coming in. And this has worked well over time. I can't say every day it is, or even every week it is, but over just about any period of time, it has really worked well. So I wanted to explain it to you, give you some detail on it, and I'll give you the backup on that. We have 7 or 8 different strategies, investment strategies. So I'm going to talk about one of them, the one that has produced the best return the most consistently and has the least risk. And that is our sector rotation strategy. This, I think, is ideal for coming into the market when you're bringing in, particularly if you're bringing in money that has been in the bank or CDs or money market funds into what's called risk capital, which is equities, stock market. This approach is designed to get attractive gains and minimize risk in all or virtually all market conditions. I will explain and give you some data on how this works. First of all, I'm going to start with the data. and then I'll get into the methodology. We started this on April the 17th, 2023. So that is just about exactly 26 months. So I'm through this last Friday. So I'm giving you 26 months of data. And this does include the subtraction of our maximum management fee, which is 1.5% per year. The rate of return net is 51%. That's a total rate of return, not an annual number, but it has subtracted our fees from it. When you convert that to an annualized number, it's about a 24% annualized rate of return after fees. The maximum drawdown, and what a drawdown is, and this is a way of measuring risk, the maximum drawdown is from a peak to a trough. That distance, and that one time, we've had a 6.5% drawdown, and then it went back up. And the other drawdowns have been less than that. So that is not something that most investors have a problem with. In 2025, our rate of return is about 10%, and the market, the S&P 500, the rate of return is 1%. This month, our rate of return is 2%, June, and the market, again, is 1% for the month of June. So I'm quick to say it's not perfect, but it has done a good job of managing risk and getting people attractive rates of return for the risk that they're taking. So here's how it works. There are 11 sectors, industry sectors, in the economy. Those are things like transportation, retail, healthcare, utilities, etc. All of those, there are companies that make up those sectors. What we do is we take the top 3. We ignore the bottom 8. The top 3 are constantly changing. You can't just say it's technology or it's utilities today. You have to look at it every day, because some days there are changes. Another one will come into the top 3 and one will drop out, or a couple, or things like that. So we're actively managing it to achieve this top 3 component. By not touching the bottom 8, it helps us a lot, because when you invest in the market, the S&P 500 or other kinds of indexes or mutual funds, usually you get a lot of garbage, and you get some which is not garbage. So what we want is just the portion which is not garbage. The stuff that the index, the sectors, or the companies that make up those sectors, which are doing well right now and are willing to make the change to something else when that changes. And it will change, and it will change fairly quickly. So this is called active management. You could call it tactical investing. It tends to go up more than it goes down. It does go down some, but not much. And at least since it's the inception, which is 26 months ago. And there are people who like to be invested. They want to be invested all the time. That's a good way to make money in the market, but that carries with it a lot of risk. Because if you constantly have money in the market's going to go up and down, and you're going to ride it up and down, unless you can find a way to manage yourself out of that as much as possible. So our goal in the way we've designed this is to invest in rising markets in the sectors that are rising the most, the 3, and to get completely out of the market when our major indicator says we should go risk off, which means there's just too much risk in the market. And when those times happen, they do happen. And when they do, we just get out. We get out until it tells us that it's a safer environment to invest. But otherwise, we're letting the rotation take care of that. What I mean by that, if we're in an offensive environment, a growth environment, we're going to tend to have growth-oriented sectors that are coming up in the top 3. That would be things like technology, retail, consumer discretionary. Those are more growth-oriented sectors. When things start to go negative, then they will drop out, and then we will be replacing them with more defensive sectors like energy, utilities, consumer staples, and healthcare. And that switch alone has done a lot to minimize risk. And when we overlay that with our risk on, risk off approach of just getting out of the market completely when risk gets too much for anything, then the combination of those has helped us to for this to perform well and to do it with minimized risk, at least since the inception in April of 2023. I stay away from bonds. You know that. And then the reason is what just happened in the last 4 or 5 years. Bonds, in this case, government bonds, but nearly all bonds, except for junk bonds, have been declining. And I don't know how long it's going to go on, but I know it is influenced by interest rates. So when interest rates go up, or the perception is that they're going to go up, that's what seems to be going on, then the bonds are going to fall. You could also go back to a period of time after World War II, from 1946 to 81, a long period of time where equities were rising, interest rates were rising, bonds were falling, generally speaking. So there can be long periods of time where you put up with this, and I just don't want to deal with it. I think we're in a regime right now where bonds are going to continue to fall because I believe interest rates are going to go up. But I don't know that for sure. I'm just saying I just stay away from it because the techniques that we use in our sector rotation strategy, the ones I've just described, seem to do a good job of getting good growth and managing the downside risk. Certainly a lot more than I could have done if I'd used a 60-40 stock and bond buy and hold portfolio. But you do need, I believe you do need some kind of risk control. You nor I are Warren Buffett, and we're not a hedge fund manager. So we've got to have some kind of technique to manage that so that we can sleep at night. I've just told you mine. I've told you why I don't agree with the traditional approach, but you need something. So that describes what we do and gives you, hopefully, if you're interested, a tool to put your money or some of your money to work to start getting back into the market. Otherwise, I think most people don't know how to do that, and they can sit for a long, long period of time always seeing all the risk and all the bad news, and there's plenty of it, and not getting back into the market. And at some point, the market will take off. Just when you don't think it's going to do that, it will do that. That's the way it works. And what frustrates people is to see their money declining. And it also frustrates them to see that they could have participated in the upside of the market when that happens, and they didn't do it. And there never is a right time to do that, other than what I've described to you is the best method we've got. And hopefully that's of help to you. So thank you for watching. If you have questions or comments, leave them in the comment section below.